What's going on, everybody? It's Jeff here. Welcome back to the channel. In this video, we're going to be talking about AMC and GameStop. What a wild week we had. And I wanted to go over three specific things. One, why that holy grail $8 mark was important for AMC. I'm also going to be talking about some controversial information that I see passed around the internet, more specifically about the call options expiring in the money and what is going to happen with them on Monday. I'm also going to be talking about some pretty cool data that I found about GameStop, which is going to lead me to believe two separate things that we're going to go over. One being where the price of GameStop is going to go next week, and also what the hedge funds might be doing potentially. And lastly, the most important thing, I'm going to be talking about how you guys can limit and mitigate your risks if you are already invested in these stocks or you plan on investing in these stocks. If you have not invested in these stocks, I will tell you, be careful. Do not invest in anything you are not willing to lose, because they are very, very volatile stocks, okay? Guys, if you're new to the channel, I would appreciate if you find any value to leave a thumbs up, consider subscribing. We also do have a private community down below. It's the first link in the comments, all right? We have hundreds of members that talk stocks all day long and really give support during some of these bloody and hype times as well. So if you're interested, guys, it's the first link in the description. Let's get into the video. First up, AMC. It closed at that. Look at that mark, 801. Look at that pretty 801. Kicked off the week just under 6, ended at 801. All right, that's about a 25% increase. GameStop, a little bit much more. It kicked off at 47, ended at 102. That's about a 110% increase, okay? As you are seeing by these two charts, they are starting to trend a little bit differently. They are spiking together and dipping together. However, the volume is much different and the percentage of gains and losses are much different. On Wednesday, when GameStop spiked 100%, I believe AMC only spiked about 20%, all right? So keep that in the back of your mind. I also want to mention, guys, too, this is the NASDAQ. It kicked off the week at 13,700, ended at about 13,200, down about 4% after already having a bloody week the week prior. Okay, my portfolio was pretty red. A lot of people I was talking to, their portfolios were pretty red. Because a lot of us have invested in these tech-heavy stocks, which have had huge gains over the last year, especially since the coronavirus took over and a lot of other sectors had fallen. All right, now let's get into what we're going to talk about in this video. The first thing I want to talk about is that $8 mark. Now, AMC had insane options volume over this past week. As you can see right here, it's number 2 under Apple. Apple and Tesla are always at the top. This is barchart.com. If you haven't used this before, it's very valuable and it updates very quickly, especially when the market is open. Now, one thing I really want to talk about is over the internet, I believe it was 154,000 contracts, call options contracts had expired on the 26th in the money, okay? And the potential for that is 15.4 million shares to be bought on Monday, okay? Well, the first thing I want to talk about, guys, is this right here. Let's go over exactly what a stock option is, all right? A stock option gives an investor the right but not the obligation to buy or sell a stock, right? The right but not the obligation, meaning these individuals that expired in the money do not have to buy that stock on Monday morning, okay? Now, when I buy call options, personally, I do not buy the stock if it expires in the money or if it ever becomes in the money. The reason being is if I were to do that, I would just invest in the stock to begin with, but I choose not to because I want that money to continue to flow. I also want to give you guys an example. On Monday, if you were to choose to buy an $8 call option expiring on the 26th, all right, and the price currently was $6 and they were selling that option for 35 cents, and you bought 10 contracts, which equals 1,000 shares, okay, the price of that would have been $350. Now, when the price rose to $8 by the end of the week, okay, your contract would have increased in value. You could have closed that out, given it back to the market makers, and taken your profit. Or you could buy that stock and hold those 1,000 shares. A lot of times why this does not happen too is individuals do not have the assets to be able to cover the cost of this, meaning you would need $6,000. You initially invested $350, that was your maximum risk, and now you need $6,000 to be able to buy those 1,000 shares plus whatever the fee is. Okay, you're going to lose your premium, right? But it's going to cost you an extra $6,000. Yes, immediately they would be worth $8,000. However, it's still going to come up with that $6,000, and that's also at a small factor. If you bought 100 contracts, you're going to need $60,000. Okay, so not all these retail investors, especially, are going to have the assets to be able to do that. Not to say it's not possible. Not to say that Monday we're not going to come off hammering out of the gates. Personally, I don't think so. I would definitely expect to see an increase, but I do not expect it to be hammering out of the gates, okay? So just keep that in the back of your mind, all right? Also, I want to talk about what might happen Monday, Tuesday, Wednesday, which you hear a lot about, which is that overall gamma squeeze. Now, first of all, guys, if you haven't heard of gamma, the way the market makers work, the options is all done in the Greek language, all right? You have the delta, the theta, and the gamma. The delta measures how much an option's price is expected to change per $1 in price, okay? Very, very simply put, call options have a positive delta, range from 0 to 1. Put options have a negative delta, 0 to 1. At the money is right at that 50 price point, and as in the call option, the delta will increase and approach that 1 as the option gets deeper in the money, okay, and vice versa. Very, very, very simple, all right? They use this to be able to hedge how much risk they are at. The gamma is the term that is talked about, the rate of change of the delta. When that variance is very, very dramatic is when the potential for a gamma squeeze can happen, okay? So basically, what happens is the market makers will be, when there a lot of call options are being purchased, the market makers will begin to purchase shares to be able to hedge their risk. Okay, that is what could cause a gamma squeeze. Not to say it always has to happen, and it also happens mainly when call options are being purchased, not when call options are expired in the money. Okay, just to give you some perspective of how you know that. That's why when you saw GameStop in the end of January, it had that initial gamma squeeze because insane amount of call options were being purchased at a very, very, very low cost, and in return, the market makers had to purchase a bunch of shares to be able to minimize their risk. Okay, very, very simply put. Also want to talk about, guys, this is back to bar chart. If I look at this, what is expected to happen between AMC next week? There is insane amount of call volumes happening for a $15, $10, $11. Okay, I believe you got a $16 down here. There's $20, $25. Insane, interest change, which is absolutely awesome. The implied volatility is there. Everything is good. A lot of them are expiring on the 5th, which is this week. We also have some, this is the 19th, okay, which is not even that far out, guys, but there's a lot of them on March 5th, which is good. If more call options continue to be purchased next week, the chance of that gamma squeeze happening is there, especially when we know that there is not a lot of shares available because us retail investors are continuing to buy and hold, and they have those diamond hands, as everybody talks about. So just to put you into it, guys, a little bit of perspective of what might happen on Monday for AMC. Now, going into GameStop, what I wanted to talk about, okay, was this. This is going to go into my last 2 points. GameStop. This came out from a tweet from Quant Data. I've been following them for a little bit of time, and as I'm not always to be able to 100% exactly see what they can see, depending on what algorithm, software, and whatever they use, I found them to be pretty reliable, but please take everything you see on the internet with a grain of salt. I want to point this out. Friday, February 26th at 3:33 p.m., okay, an investor initiated a contract, okay, or initiated an option, 2,000 contracts, okay, with a $250 strike price for GameStop, expiring March 5th, all right? It was $12 was the price per contract. That's a $2.4 million premium that they invested into this. So that might give you some option of it saying on one side of the spectrum saying, wow, this individual feels like GameStop is going to increase past 250 come next Friday. Now I want to pay attention to this because I want to give you that inverse effect, all right? And this is what I'm going to be talking about, mitigating your risk. This could be a hedge fund that is trying to mitigate their risk, which means they have shorted the stock. They are very heavy on shorting the stock, but they initiated this call option, okay, in case the stock goes the other way, all right? So meaning if their huge short ends up going red, they have that call to be able to bring some money back coming in. Now, let me give you guys an example. I'll give you a very clear example for CCIV. When CCIV spiked, I had about 1,000 shares in CCIV. When it spiked to $45 a share, I issued a put option at a $30 strike price. And it was very, very cost effective for me to do this. Meaning, if the stock, because I was long on it, okay, but I issued a put option. I was long on it though. If the stock went to $60, $65, I would lose out on my premium from the put option. However, I would have made so much money on that increase that it's okay. Instead of maybe getting 100% gain, I get an 80% gain. That's fine. However, in the inverse is that if the stock comes back and I lose out on it, at least my put option becomes in the money. And the amount of negative I am, because I was long, the amount of negative I am is less. Okay, this is what's called hedging your position. Now, I know we talk about hedge funds all the time, but it's called hedging your position. A lot of experienced investors do it. I highly suggest you start researching a little bit more about how to hedge your positions. I've been doing it probably for the past 3 years. And while my gains tend to be a little bit less, because when I am long on a stock and I issue a put option, I lose out on my premium most of the time. What has happened in situations where I am wrong about a stock is the amount of money I lose is less. It softens the blow, okay? So your gains might be a little bit less because you're issuing a put when you're going long. However, when the stock pulls back, and especially when you first buy it and you first get into it, if you're running up on a high growth stock, the blows are a little bit less. So it is a possibility, right? So look at this from either perspective. Either there is a bull in here that is risking that $2.4 million, or the hedge funds are utilizing this to hedge their investments and mitigate their risk. So just a potential option for you guys. It was pretty crazy. I really wanted to show you this one and also give you guys an example of how you can mitigate your risk when investing in any stocks, not just these. It could be whether you're investing in, a long Apple stock and you wanted to issue a little bit of put as long as, the premium isn't too crazy to help mitigate some of your risk. So guys, if you have any questions and you want me to give you some more research about how to mitigate risk and how to hedge, please leave a comment down below. I would be more than happy to do it. That's it for this video, guys. I can't wait for Monday, and I will see you in the next one.